Let's be real. Most people have no idea how home lending works. Today, we're going to set the record straight. This is Real Estate Unfiltered. How's it going, everyone? Welcome back. My name is Memo.
Welcome. I'm Chris, and today we are with a very special guest, Brian from Direct Home Lending.
Hi, everyone. I'm Brian with Direct Home Lending. We've been around for about the past 20 years, and I'm the owner-operator.
So as we're in today, where do you see the rates as of maybe today, and obviously nobody has a crystal ball and knows exactly what's going to happen, but what do you foresee maybe the next 2 weeks, 2 months, or anything going down the line?
So we're in the middle of March, right? So obviously with the war in the Middle East, it's really going to be driven by that news, right? What's happening with oil? What's happening with the Strait of Hormuz, and are boats come in and out, or are they limited? So it's difficult to kind of judge the next couple of weeks. It's really going to be based on what's happening over there. In the long term, I think rates are still coming down. I feel like they're going to come down through 2027. But in the short term, with what's happening in the Middle East, it's kind of volatile.
Yeah, I'm kind of two questions on that. Like when you mentioned oil, do you think oil is one of the bigger factors in it that's keeping the rates where they're at?
Yeah. So rates were headed down, right? Beginning of the year was really good. We got to about a 30-year fix at around 5.6, 5.7 with no points, which is, we haven't seen that in probably 4 years.
Right.
And then obviously oil spikes. So when oil spikes, the cost of everything goes up, right? Because, transportation costs, right? They put stuff on trucks, the trucks have to deliver, the cost is more expensive. So the market gets scared, they sell bonds, makes the rates go up because they feel like inflation is going to kick up because the cost is going up for oil.
Right. And then you said the rates did go up. Did you mention there's like right around 6-ish or 6.1 or something like that? Or
yeah, rates today are probably 30-year fix with no points, probably around 6.125.
So yeah, they're not horrible.
No, still great rates. I mean, there was a point in 2023 we hit 8%.
Yeah.
So when you're comparing it to where we were in 2023, it's phenomenal. If you compare it over, last 35 years, the average 30-year rate is, I'm kind of going off of memory, but I would guess it's around 7.7 to 8%.
Sure.
So even historically, the rates are really good still.
So then hypothetically, again, because nobody has a crystal ball, after, let's just say, the oil prices come down, in the Middle East, everything gets kind of settled like over there.
Yeah.
When the rates do come down, I mean, realistically, how low or do you think they'll go? I mean, obviously, I know it's speculation, but
yeah,
I would say let's think of the short term, right? What does this summer look like, in your opinion?
Depends how long this war goes for. Let's assume by summertime, hopefully, God willing, the war's over.
Right.
Right. Now we go back to data, right? We go back to where's inflation? Is it coming down? Which it should, because that's where it was headed down. Jobs were getting worse and worse, meaning more people were getting unemployed. Unfortunately, they were staying unemployed longer. That helps rates stay down because it's more anything volatile usually will help rates come down, right? Because investors are going to invest in something more secure when it's a volatile environment. So war being over, we should slowly come back down, right? I thought at the beginning of the year, 30-year rates would probably by the end of the year be around 5.8. I was off because in February we're at 5.6, 5.7. It was way faster than I expected.
Okay.
So assuming by summer the war's over, I think by the end of the year we'll be probably close to 5.6 again. By summer hopefully 5.8. It just depends on obviously, are we back to not fighting or what's happening?
Yeah. It's always fun when an extra wrench gets thrown in the system that no one expected.
Everything was going smoothly, then all of a sudden something happens. It always does. It's real estate, In between those two price points, they have, like you said, 6.1 or 5.8 or something. Realistically, let's say we have a buyer. I mean, should they wait for that to go down, or what's that really going to do to their monthly payment if they say, hey, I'm going to wait to the 5.8?
Yeah, so it's a good question. So we've all heard, what is it?
Marry the house, date the rate.
The rate,
yeah.
Right?
We talked about that, I think, in our
sounds,
second episode. Yeah.
Yeah, but it sounds salesy, right?
Yeah.
It sounds like I tell my client that, and they're like, oh, he just wants to sell a home, or he just wants to do the mortgage. But I've been telling clients that since 2023, right? 2022. Look at where rates were, right? Rates have come down. Even where they're at today, they're still lower than they were. And values are up. So if the client would have done it, they could have purchased the home cheaper, because you can't go back, right? So a client buying a home in 6 months can't say, well, can I have the price from 2 years ago? Because I thought about doing it then, right? You can always refi. Rates will be coming down. When the market gets back to normal, there's no war. You know, everything that was coming out of the White House, everything that was coming out of the Treasury Secretary, they were all aiming to help do things that are going to lower rates.
Yeah.
They're putting someone that replaces the head of the Fed, even though he's maybe not the most dovish person, he's still, in interviews that I've seen, he's still trying to push where rates are now. He feels they're too high and he wants to push them down. So everything's pushing the rates down.
Right direction.
So 100%, this, you know, for the past 4 or 5 years, I've told everyone, you know, actually, if you talk to my family, I've told them since 2010, buy the home as fast as you can, because you're going to do nothing but pay more. Don't worry about the rate, because you can always refi.
And I'm sure you've come across a lot of people that did take your advice. They bought with the higher interest rate. So right now, are you guys getting inundated with refis?
Yeah. So it slowed down a little bit, obviously, with the rate jumping a tiny bit. But as you know, refis are very sensitive to the rate, right? Even today, though, there's people that, you know, bought in 2023, bought in part of 2024, and they're at 8, 7, high 6s. And if you're at a high 6 and I can get you down at a 6.1, and what we try to do on refinance, especially with our past clients, is we try to give them a lender credit to cover all their costs.
Okay.
Right? Because if I have a client, let's say they're at 6.8, and I can cover their costs and get them to 6.1, well, now they saved a good amount of interest. They didn't incur any title and escrow fees because we help cover with a lender credit. And then as the market improves, and if I'm right, by the end of the year, we're at 5.7, 5.6 again. Now I can do another free loan for them, cover their closing costs with the lender credit, and lower the rate even more.
So let me ask you this: what is that threshold where you would say it makes sense to refi? Is it at 1%, 0.5%, 1/4%? Like, where does it start making sense, and where does it not?
So to me, there's no rate amount, right? Because if you have $1 million loan, 1/4% lowering of $1 million loan is a much bigger hit to the payment than if you have a $100,000 loan.
Yeah.
So what I always tell my clients is, look at the cost you're paying for the loan, right? And then look at the savings, right? So if you're saving $200, but it's going to cost you $10,000, well, is it worth it? You know, I don't know.
Not, no.
Probably not. But if you're saving $100 and it's costing you zero, well, I'd rather put the $100 in your pocket and in your family's pocket and put in your savings than you keep giving it to the bank. So I'm more about the dollars you're saving, the dollars you're paying.
Yeah.
Is there any myths that maybe our viewers don't know, that maybe for refi, that I have to wait a year to refi, or I can only refi so many times in a year?
So typically there's what's called an EPO. So normally what happens is, if you do a loan for someone and they refinance within a 6-month period, we as the direct lender have to pay the investor back everything they paid. So
Gotcha.
let's assume, you know, we charge the point. So on a $500,000 loan, a point is $5,000. And then I was trying to help that client. So I gave them $3,000 of that money, or $2,000 of that money, to help pay their fees. So I made $2,000 or $3,000. They got $2,000 or $3,000, right? When that EPO happens, I not only have to pay back what I made, I have to pay back what I paid them.
Oh, wow.
So basically,
So
you're losing
5,000 total.
Yeah, you're losing. So normally, what I usually tell my clients is, you know, we'll help you with the refinance, we'll cover your closing costs, but typically we can't close within a 6-month window.
Okay.
So and I've heard that a lot, or what I hear a lot too, or what you hear from clients, that, hey, my lender said I can't refi for 6 months, like it's illegal, like you can't do it. But that's what people don't realize. It's not illegal. It's just they're not going to tell you the truth because they don't want to get hit with the fee on the back end.
And I'm pretty upfront. Like, there's no point in lying to people. There's nothing illegal about it.
Yeah.
It's just, hey, like, we all work, right? I did this business because I honestly love helping people. I used to be in the fitness industry. You can't really tell right now, but
No, it's the cameras.
It's the cameras and it's bulking season. So
I used to be in the fitness industry, and I did that because it's just the reward of seeing people get healthier. I have always liked finance. I studied finance. So that's kind of what led me to this. But no, for sure, I lost my train of thought a little bit on that one. But ask your question, because I totally lost my train of thought.
What was the question?
What was the question?
Oh no, about like the EPO you were saying about.
Oh yeah. So
the $5,000.
So I'm pretty upfront with it.
Yeah.
Right. Like, I work, I make money. and I'm helping, and
in business, the best thing to
go
do
compare
is to
the
be honest.
pricing. I'm going to give you the best deal, but I'm also going to be honest to say, look, you have to hold it for 6 months, right? Let's say the rates plummet. I usually tell my clients, because we can do a longer lock. Like, let's say I do a loan and in 3 months the rates just for some reason plummet, and my clients are calling me saying, hey, like, I want to do a loan. I can do a 90-day lock the rate for 3 months so they don't lose the deal, but we're still closing it outside of the 6 months, so it's also fair to us as people that work for a living, and obviously you have to pay bills and feed your family.
It's still a win-win.
Yeah, everyone wins. And honestly, it's worked great. I have clients now that call me and they're like, hey, someone else called that gave me rates, but I know you helped us last time. You were going to give us a lender credit. I loved working with you. So, that's also rewarding, right? So as long as you take care of them and you're honest with clients, they're going to reciprocate.
And probably waiting the full 6 months is going to benefit them in the long run, like anyway, because that's going to give more time for everything to settle down, and the rates are probably going to go down
for sure, especially today.
Yeah. So don't do multiple refis. Let's wait it out and see where it goes, and then do a big one.
Yeah.
So with the rates, obviously it is what it is. It's a volatile market, and buyers always say, oh, I'm going to shop the rates around and everything like that. For the most part, rates are what rates are. The differences are either which lender's giving kind of cutbacks more to bring the rate a little lower on that kind of sense, or credits back type of thing, because that's what could change the rates, right? For the most part.
Yeah. So lender by lender, broker, or a large institution like a B of A or someone like that, rates will change, credits will change, right? I always tell clients, look, one, you want to feel people work with people they like.
Yeah.
You want to feel the person's honest. You want to feel that they're trying to take care of you. You want to feel they're knowledgeable, right? And usually most people can talk to someone for 5-10 minutes and figure out, okay, they know what they're talking about. They're really genuine about trying to help me or not.
Or they're just full of shit.
Yeah, in my mind, having the lowest rates is great, but it's still, you still want to take care of the client. You still want to service the client, because for example, I have some investors sometimes that I have a 0.25% better rate, but I know if I take them there, the client's going to have a terrible experience because their process and their underwriting is just horrendous, right? So usually I'll just be honest with the client, be like, look, here's where I would go. Here's what the rate is. If you go here, I can get you a better deal, but here's what you're going to go through. Yeah. You really want that experience, right? And then I'll let them decide. But I try to be as upfront as I can. We should all do that in this industry, but yeah, it's it'll change a little bit, and big institutions, for example, let's say you're working, and I don't want to name anyone, let's just assume you're working with a big institution. The reason typically like a broker's pricing is going to be better, or a small direct lender is going to be better, is overhead, right? So if you're working with a big institution, the person that's sitting across the table from you has to get paid. They have a assistant manager in the store. They have a manager. They have a district manager. They have a regional, a VP. Every single person gets a chunk of that money. So that's why 100% of the time, working with a broker or a small, like a direct lender, they're priced way better than what you're ever going to get at a big institution, because you're paying for all those people.
Yeah.
So
it makes sense. All right. So let's kind of reverse back a little bit. Let's kind of dumb it down. Walk us through like a normal, bringing you a buyer as agents. Where do we start? Because everyone always has the conversation with us like, hey, I want to buy a house. I don't know what I qualify for. I have bad credit, whatever the case might be, but they just don't know where to start.
I don't have 20% down. I don't have the money.
And that's a big myth too. And we get it a lot, where everyone automatically assumes I need 20% down to buy a house. Yeah. So we know that's obviously not the case, but let's talk about we bring you a buyer. Hey, Brian, they want to buy a house. Where do you start from there? What's your process? What do they need to go through?
So normally the agents I work with, I tell them, hey, put us on either, let's do a intro call together, or put us on like a 3-way like text, right? So everyone knows what's happening. Normally the first call to the client is just getting to know what they're trying to do, right? What their goals are, what their outlook is for their family, for themselves, like how long do they see themselves staying in this property? Is it a first step, and then they're going to want to go to something bigger, like kind of what they're trying to do, right? And then kind of I'll sit down with them and go through, what the process looks like, right? From beginning to end. Because a lot of first-time buyers, and I remember myself, it's exciting, but it's also scary.
Oh yeah, they're all
stressful, and you don't know what's coming because you've never done it. So the more we can tell them, hey, here's exactly what happened from A to Z at the end, the easier it is, and the process becomes more comfortable for them. So the first call is really getting to know them, and them really getting to know us, right, as a company and as an LO. And then the second call is usually we've done their application already. We've already kind of ran through what they qualify for, what programs they qualify for, and then really tied into what their goal is. Like, how long do they see themselves living there? What they're trying to do with the property. And then on that call, it's either in person or we'll do it on a Zoom usually. We'll kind of go over the programs they qualify for, what the payment looks like, what the cost estimates are going to look like that they need to expect. Because a lot of people think, hey, my down payment is this much, I'm good. But they forget about, title fees and escrow fees, and you got to pay a full year of insurance when you buy a home, and all the other fees that come with purchasing a property.
Yeah,
right?
'cause it's not just the down payment. I
Right.
mean, obviously, if we're able to, as agents, get them seller credits, that'll cover it, lender credits,
Exactly.
whatever. But it's not just the down payment.
Right.
But I think a lot of lenders out there too, like they will just say, okay, here's what you're approved for. Here's your pre-approval letter.
Right.
It sounds like you actually go the extra step and say, okay, here's multiple different loan programs that you
Right.
qualify for. They might be a little different in payment and this and that, but then you kind of sit down with them and help them pick which one's best for their family.
Yeah, I mean, right, exactly. Part of that also is so what happens when our loan closes with us, the client goes into a system that on a daily basis is checking the market against their particular loan. So let's say they have a 30-year fix. So that system it's an AI. It's automatically checking rates every day. Yeah. As soon as the rates are 0.25% lower than what they have and we can cover their cost, the system will actually notify the LOs. Right.
Nice.
So part of what we cover for them is like, hey, don't look at us as we're going to help you buy this home and then we're going to say, see you later. Right. My goal is to, you have a investment person to help you grow your money. My thought is, hey, I'm the person that's going to help you reduce as much debt as possible.
And that's something cool that they don't have to watch the market. They don't have to say, oh, it just dropped. It's time for me to call Brian back. Right. That's something that you're already doing for them, like on the back end.
Yep. And it's all automated. So, because there's no way we can keep up as an individual and check everyone. So it makes it, they can feel comfortable getting into the loan they have. And this is where that should I buy now or later comes in.
Yep.
They can buy now and know that as the rates drop, they're going to get notified right away.
So kind of like when you do sit down with them and you give them like the different programs, and there's FHA, conventional, VA.
Yeah.
Can you kind of like touch what are those different programs and how can one benefit more than the other?
So there's not one program better than the other.
Okay.
Right. I always tell clients, like, it just based on your needs and what your goals are, there's a program that's going to be best suited for that. Obviously VAs are veterans, 100% financing. If they have a 10% more disability, their funding fee that VA charges is waived. It's probably one of the best loans, and I love VA loans. It's one.
So do I. I don't know why a lot of listing agents frown upon them.
I don't get it either.
They want that person to get into the house, and they will work with you. I mean, that's why they have the Tidewater, so you can fight the appraisal. But they actually want their VA.
They want the veterans in the
house. So they're
100%.
the most easiest to work with, like I feel.
Yeah, they're the most lenient on debt to income ratios, which is how we kind of qualify everyone. They have some of the best rates in the market, way better than conventional rates. I mean, there's no other 100% financing with no mortgage insurance.
Yeah.
Right. I mean, it's by far the first question I always ask clients: are you a veteran? Right. One, to thank them, and secondly, because that's the angle I'm going to take, because it's the best thing for them if they qualify.
Kind of like a follow-up question on the VA that probably people a lot don't know. Can they have 2 VA loans at one time?
They can. It's a little tougher, especially in California. It depends on home prices. But a person can have a VA loan, then purchase another home, rent that home out that still has a VA loan if they have enough left on their eligibility.
Gotcha. Okay. Cool.
So talking about that real quick too, like how does that eligibility work? Like what's the number just based on how long they've been in the service type of thing? They get a X dollar amount that they're able to utilize, or how does that work?
So honestly, I don't know 100% how that works. They don't have to be in the military. They can be in reserves too.
Yeah.
But normally what we'll do is we'll just the eligibility, we just request it basically.
Right.
And it'll tell us if they've used it before, if they haven't used it, if they're eligible, or they use their full one on a different property.
You type it in the system and it tells you.
So VA just says, okay, this is
will
what
give
the
us a certificate that basically lets us know if it's available or not. And then it tells us based on a calculation how much of it is available, right?
Gotcha.
If they've already used part of it. But yeah, probably the best loan in the market. FHA is great. Funny, story. My first loan, when I bought my first home, I say 22. My wife says 24. So I don't know.
She's probably right.
She's probably right. She's probably right. But it was now looking back, because at that time I was in the gym business. I had no clue what I was doing for the mortgage. But it was the FHA loan that I did. I thought it was the best thing ever. I put down like 3.5%. I remember it closed. I got a check back. And I'm like, I just made money like buying a home. This is
Nice.
you know what I mean? I was like, I still remember that. I was like, the feeling I had was like amazing. So FHA is a great loan too. It just depends on the scenario, right? FHA is good for someone that wants to put a little bit of money down, maybe has a little bit lower FICO score, maybe a higher debt to income, because FHA will let you go a little bit higher than conventional loans. And then your conventional loans, you could put down 3%. Like, again, you're right. Majority of the public, and I've done multiple videos on this, because majority of the public think I have to have 20%. I got to sit here and wait and rent.
We get that all the time.
Right? Yep. Well, when you rent, you're paying 100% interest.
Yeah.
You're getting no write-off when you do your taxes. You're getting no appreciation because you don't own the property. Like, the sooner they can get in, the better for sure. But conventional is great too. 3% down for a first-time home buyer. 5% if you're not a first-time home buyer. This is owner occupied. I mean, there's so many. I don't want to bore everyone to death. But
no, and
but
this is more just
there's a lot of things to it.
stuff.
But yeah, and that's why the first call is always kind of getting to know the client, their goals, what they've done in the past. Kind of.
So let me ask this: with that
Sure.
with that first intro call or whatever, what can a buyer expect to need to provide to you to start the process?
So on the initial call is really just talking to them, right?
Yeah.
But I do tell them, like, if they're self-employed, typically we'll need tax returns. If they're W-2, we'll need W-2 and pay stubs. Obviously bank statements for wherever their assets are coming from for the down payment or the cost. And those are things that we'll collect after the first call so we can prepare for the second call. But really, the initial stuff, and this is the difference, I'm sure you guys are going to ask, pre-approval, right?
Yep.
Pre-approval,
pre-qualification.
So for those people out there, do not do a pre-qual. A pre-qual means I just picked up the phone, you told me a story about where you're at, and I said, great, you're good. Here's how much you qualify for. Because I saw none of your income. I didn't look at your credit. I didn't really dissect, can you really qualify for this? A pre-approval is, we've looked at your credit, not only the score, but we've looked at your liabilities, and do you have any derogs, and do you have any charge-offs, and we looked at your income, we looked at your assets, and we've actually ran it. And in most cases, and this is one of the great difference, like, I know there's other companies doing it too, it's not just us, but we can do a fully underwritten pre-approval, which means not only did I look at it as the LO, but I actually sent it to my underwriter. They reviewed the income, they reviewed the assets, and they said, here you go. This is approved at this max dollar amount.
And doing most of that work up front, yes, it's more work for you, but it just makes it easier down the line. You can close quicker.
Yes.
And sending those offers to the listing agent, I mean, that's what they want to work with as well.
Right.
So yeah, doing the work up front, I think definitely benefits the buyer for sure.
And it gives us the opportunity as agents too, where if we do have that fully underwritten pre-approval, now we know, hey, we could close 14 to 17 days.
If needed, yeah.
If needed, we could lower contingencies. So it's making our offer stronger to that agent.
Definitely.
Because if it's a multiple offer situation too, you come in with 3-4 other buyers and say, hey, look, yeah, we have a loan, but we've fully ran through the process. We're able to go in, we could cut contingencies, remove them in certain situations, whatever the case might be, but it just makes us look stronger.
Yes.
And it's because we did our homework. It's because we've done all that background work versus, like you said, hey, how much do you make? Oh, you make $100,000 a year. Okay. And you have 500 in credit card. Okay, cool. You
Here's
qualify.
Here you go. Go shopping.
Yeah. I tell all my team, like, majority of work is done on the pre-approval. When the offer gets accepted, like, there's not much for me to do.
Yeah, you
right? Maybe I need an updated pay stub because mine are a couple weeks old.
Just chasing paperwork at that point.
That's done. Everything else is finished.
Yeah.
Like, if you're a good LO, the work is on the pre-approval, right? The rest of it is easy.
Yeah.
Because you already done all the work. You got it approved. You know where you're at. You just need maybe update documents and you just shoot it through. Like, that part's so simple.
Like, I kind of want to go back to like the current market right now, because I think you guys probably see it first when the market does shift, because the amount of applications, rise and decrease. It's like, where are we at now? Are these kind of stagnant? Are they dropped?
I mean, it got really, everyone got slammed in like beginning of the year through like right before the war, right?
Yeah, right.
It slowed down a little bit, right? It's still good, still getting calls. And you're right, we see it first, right?
Yeah.
So consumers that already have a mortgage are the first ones that are going to jump in and say, oh, rates are down. I heard the news. Let me try to go get a refinance and lower my rate, right? The ones agents see it later because the person wanting to purchase a home is sitting back.
Yeah,
They're like,
because our showing requests slow
yeah,
down.
then they got to,
So it's
yeah.
it's a ripple effect. You guys see it, and then we see it a couple weeks later.
And it's those buyers that aren't in a need to move. They know they want to move, but they don't need to move right this second.
Exactly.
So they'll play the market. They're sitting over here on the fence.
Yeah.
And I mean, that goes back to what we've talked about too with sellers and buyers, where you have all these buyers sitting on the fence. So if you're not making moves right now when people don't want to buy a house, and you wait for something to happen, all those buyers that are pre-approved, ready to go, they're going to flood the market, and now you're competing with
everybody else again. Yeah,
for sure.
I mean, it's the same thing that happened during COVID, right? Like, yeah, there was $50,000-$60,000 over asking price, all that kind of stuff. But even those people that bought something back then, they're sitting on a great part of equity.
Yeah.
And those people that were on the fence were like, okay, I'm waiting for something drastic to happen, and guess what? They're still over here.
The date, the rate, marry the house. It sounded stupid, but
Yeah.
it was actually true.
Let me help all the viewers. Values are not coming down. No matter what you hear in the news, no matter who tries to sell some training to you about the biggest foreclosures, are not happening.
Everybody has so much equity right now.
We're at historical equity levels, right? In the last 85 years of home appreciation, depreciation, there's been only, I think, 4 or 5 years out of 85 that values came down. 3 or 4 of them were because of the 2007 crash, right? Where housing caused it, right? If you take that one-time event out, I think the largest depreciation we've ever had, which was 1 or 2 years in 85, was 1% or 0.1%. Sorry. So values will go up every single year. So you're either going to pay more later or you're going to pay less today. Yeah. Rates are going to get better. And I'm not trying to push anyone to do a loan or not. I've seen it for 20 years.
Again, like you said, you just want to be honest with people. It is what it is. Yeah.
And it's the same thing going back to what you were saying earlier with a $3,000-$4,000 rental. It's 100%. You're giving it to someone else, doesn't benefit you whatever other than a roof over your head, doesn't give you a write-off on your taxes, where people that are making good money that are W-2'd and can't really write things off, they need a house. Yep. They need that property tax write-off. They need the interest write-off. And that actually saves them money too. And I'm sure you go over that with them. It's like, hey, if you buy the house, it's technically, I mean, obviously not dollars in your pocket, but it'll adjust your taxes at the end of the year for what you owe. For sure.
It's, real estate is probably the number one wealth builder in the nation, right? It makes the most money for people, right? Like I was telling people in 2010, buy a house. The homes are probably more than doubled.
At least
in California. They've more than doubled since 2010 at minimum, right? So imagine how much money that those people have that did buy in 2010, right? How much equity they've built by just paying down as they're making the monthly payments, and how much appreciation they built. So 100%, and then again, that comes back to me feeling rewarded as personally. Like, my favorite clients are like the young, couple that's in their 30s that are like scared, and they're buying because I know in 10, 20 years, they're going to have so much equity if they just take care of their home that they're going to be in such great shape.
That's just their starter home. They're not going to be in that forever.
Well, and that's the thing too. And that's a conversation I have with a lot of buyers that are asking me. Everyone, especially, or first-time home buyers specifically, they're always wanting that first-time home or first home is to be their perfect home. It needs that.
It's like, this isn't your forever home. You're going to be here for a handful of years. And
like you're either living at an apartment right now or somewhere smaller with your parents. Like, get into something. I don't care if it's a condo. Call me in 3 years and we'll turn that into a rental. We'll build you your wealth from there. Give that as an asset for you, and then buy something else. Your first home should never be everything you want. It should be like one thing you
can't
want.
afford it. You can't. You don't have the down payment for it. Like my first home was a condo.
Yeah.
You know what I mean? And I was like, I'd rather do this than go pay rent.
Yeah, exactly.
You know what I mean? So and if I didn't have that, like, I remember selling it, I'm like, then I got the check and I'm like, this is amazing.
Yeah.
But no, for sure. Like, your first home doesn't have to be your forever home. You're right.
Yeah.
Just getting in.
So I have just like a quick question for our viewers. What's something small and easy that they can do to boost their credit? If they're kind of maybe on the low end, they just want to get it up a little bit. Is there something?
Well,
tips?
and everyone's on Credit Karma or
and those are never accurate. So let
me kind of talk about a few. Sorry guys, I like talking a lot. But so regarding credit, what you pull on Credit Karma, on any consumer credit pool, even car credit, is a different score than what you're going to get on a mortgage pool. The bureaus do not tell us how their calculation and why it's different, because they don't want anybody to try to manipulate it. But it is always harder to get a higher score on a mortgage pool than anything else. Yeah. So the first thing, I think you guys, I don't know if you guys asked it or it just came up. The first thing I would always do is check your credit, right? How do you get, what should you do at the very beginning? Even when your thought is maybe in 6 months I want to buy a home, start paying down your revolving debt. Don't pay off your loans that are installment. What really helps you is, or one of the things that'll help you the most is having the least amount of revolving debt, right? So what the bureau wants to see is, hey, look,
well, let me ask you something real quick. So you mentioned revolving installment. Explain those. What's the difference for people that don't know?
So revolving is like a credit card, right? Meaning I use it, I pay it, I can use it again.
Yep.
An installment is like a personal loan,
car payment or something.
Yeah, car payment. I buy, I got a loan for $10,000. As I make my payments, I pay it down, but I can never use that money again. Right? Where a credit card, as you pay it, it empties out, you can use it again. So
for credit card, is it a myth that you don't want to pay it down to zero?
So typically you want to have like, I've heard different things. Usually the most I've heard is 5 to 10%.
Right.
That's kind of ideally what they want to see you use it, but not need it. Right. And that's really what they want to see.
It's all ass backwards.
And the crazy part is, like, years back when I put someone's credit, it didn't show me their payment history. It just showed me what their balance is, how much they owe, what the normal, what the payment is right now. Now, what the underwriters are seeing is your entire history of how you've paid,
how many late,
how much you've used, right? Look at the balance going up and down on the credit card, and then how much are you paying minimums? Because that's what they're looking for. Like, okay, are you increasing your balance and you can't afford to pay it off, so you're barely making your payment, right?
Makes sense, yeah.
But easy way to fix your credit: start paying down your revolving credit cards, right? Yeah. And your, Nordstrom cards or whatever, anything that is reusable, like a revolving, you pay those down, you're going to get the best increase in score.
Okay.
I think that's good advice. And
so talking about credit too, there's ways that you're able to get someone's score up quickly versus having to wait the 30 to 60 days.
Yeah. So that same thing. So what we can do is we can pull someone's credit, and it again comes back to the revolving credit cards. Yeah. If I can see that, okay, hey, you have, $20,000 limit, you're using 10 of it. Well, if we pay 5 of it down, we have systems we can run that'll tell us, okay, well, with a $5,000 usage, the score goes up 20 points. And if they do that, basically what they'll do is they'll pay down the credit card. They'll ask for a letter from the credit card company that says how much their new balance is. And we typically can rescore them within probably 2 to 5 days versus having to wait 30 days for the credit card to report.
So that'd be something good for someone that's selling the house and then purchasing. Yeah. Because they're selling, and then they can use that equity to pay off those cards or whatever that they need to do. Yes. Then you do a quick rescore, and now they're pre-approved to buy
much
that
better,
second.
Yeah. Much better rate. Let me one other thing for credit cards. This happens all the time. I call my client. I'm like, hey, you said your credit card balances are zero, but you owe this much on the report.
Go put money on it.
And they're like, well, I paid off every. So what's happening is the credit card companies report once a month. And if you look at your statement, it shows you when your cycle is, the monthly cycle. What you want to do is about 4 or 5 days before that date, pay your credit card. Because when they go to report now, 4 or 5 days later, it's going to report zero. What's happening with the clients that always tell me they pay, but there's a balance, is they're paying it after that. So the credit card company is reporting the balance, and then they're paying.
Gotcha. And this all happens before it's due too, because there's a statement cycle, and then it's due the next 15th or whatever it is. Right. So don't pay it after that, because then it reports. Right. It's before the statement closes.
Yeah, and you'll see it on your. And if you can't figure it out, just call the credit company and say, "Hey, what's the date you guys are reporting?" So you can pay it a few days before.
No. So kind of shifting gears here. Do you have any sort of horror stories that you might be able to share with us? Some deals you might have saved, some crazy stuff that came up during the process. And
basically tell buyers what they shouldn't do.
What not to do and how they can be saved.
So from all the horror stories, now we give them a form that basically tells them all the do not do these things.
Don't do any of these things.
Don't do, because we've gone through all of it.
Oh yeah, people go out to the like you said, Nordstrom's, and they'll get a credit card because they think they're saving the 10%, and then all of a sudden, I can't buy my house now over something so small like that.
Or they go to Best Buy or Lowe's or Home Depot, 0 interest for 72 months on all the appliances that I need or all the couches I need.
Yep, okay.
I've had all of it. So Investors can recheck credit at the end. Now they don't run a hard pull, right? But they can see if you've added liabilities, right? So I've had it all. I've had clients in the middle of a loan process, unfortunately, get separated,
Okay.
right?
Well,
I've had people like, quit their jobs and try to go, open their business in the middle of a loan.
Yeah.
All the things not to do. Those are probably the worst ones, like where your hands are tied. Like I can't.
Yeah,
There's not much I can do anymore.
Yeah. Well, and that was going to be my question right now. So, like, of those two, those are dead in the water.
Those
There's
are dead
like,
in the water.
yeah, the
yeah,
guy
can't
just,
save
if
it.
you just quit your job, you don't have income, so you're starting a business. It's kind of
Okay, quick on that though, but there is a caveat on that, right?
For which one?
So if someone quits their jobs and starts a new job, because I know the answer to this.
So it depends.
Exactly.
if it's in the same industry.
So
yeah.
so it depends. So are they quitting and now they're still W-2? Or are they quitting or are they self-employed? Because if you're
that's gonna change
self-employed,
it,
correct.
it's going to change things. Because self-employed, I don't know what your write-ups are going to look like. I don't know what your expenses are.
Yep.
So majority underwriters are going to be, that's a no-go. But now I quit my job and I want W-2. So if you go from self-employed to W-2 or you go from W-2, you quit your job and you're still W-2, we can still make that work.
Yep.
It just, I don't want to bore you guys to death on this one, but that can still work. So that doesn't end things. Trust me, we do, not only us, even though sometimes clients don't feel that way, underwriters really want the loan to close. They're not trying not to close loans, but
They're very nitpicky, but but they want
still
to.
got it. Yeah,
They got to do their job.
At the end, what everyone's got to understand is roughly 70 to 75% of all mortgages in the country get sold to Fannie or Freddie, right? So Fannie and Freddie put out their guidelines, and that's why every investor basically follows that because they want to be able to turn around and sell it to the biggest buyer in the country, right? Is when they need to liquidate a little bit. So underwriters are really just following whatever Fannie says, and if their loan isn't sellable, then obviously I messed up, and now I can lose my job. So they're trying to make sure they don't lose their job.
Yeah, exactly.
But on a good note, so I'm not going to take credit for this. This was an LO in my office, but it's just recent and it's a good story. We all have heard about the California Dream for All, right?
Yep.
On the first run of it last year, the LO's name is Anwar. He got a call from a client that was approved for that program with someone else. And that program, you guys, just because you're approved, you don't get it. It's like a lottery. So they got lucky to get picked. And now they're getting from, 0 to up to 125,000 down payment, which is phenomenal. Well, the other lender pre-approved them. They got picked. So they're excited. And they just, they came from a different country. So they didn't have 2 years history here. Well, then that lender says, well, sorry, you got the up to 125,000 to help
Congratulations,
you. But
now
you
you
don't
can't
qualify,
use it.
Right? So somehow Anwar got in touch with them, and he went on and above. It was pretty phenomenal. Like he went and through the jobs they had in the country they came from to be able to show a 2-year history of, hey, look, they were in school, then they worked, and this is in another country. And he had to prove this by documentation. And then,
Might have been a different country, but it's the same type
but
of
it's
work.
right? That's what they want to
yeah.
see is, and now look, they're here, they're working. So he tied it all together. They got their home, which was a great story. Like they were
awesome.
Like that.
So you're basically saying all lenders aren't created equal.
For sure not.
just like realtors.
Yeah.
For sure not.
I think on that note and that story, it's probably a good time to, do you have any final thoughts that you would like to address? Or
No, these guys are awesome. You guys, they not just because I work with them, but they're awesome realtors.
Shameless plug.
Shameless plug.
Yeah, we'll take it.
Awesome LO too, by the way. No, I'm just kidding. But no, but definitely, like, no matter who you do the loan with, if you're thinking about buying a home, don't sit on the sideline. I've had family members that I've told since 2010 buy a property, and they were like, well, no, I can't afford a house. I don't want to get a condo. They still don't own a property. The amount of money that person has lost, I feel terrible that I didn't push them enough because they've lost so much money they could have for their family. So for sure, your first home doesn't have to be a dream home, but buy something to start building wealth.
Correct.
Yep.
And on that, thank you again for watching. We look forward to seeing you guys next time.
Subscribe, like, share, and Brian, we want to thank you for coming on.
Thank you for being
Thank
on.
you.
It's been
Thank
great.
you so much.
Appreciate it.
Thanks, everyone.